You're early, because something just happened over the weekend that may change how markets behave this entire week. Ceasefire talks failed, oil jumped, inflation expectations shifted, and silver dropped towards $73 almost immediately. This is not a normal move, this is a reaction. And if this continues into full market hours, the real move may not have even started yet. The markets are reacting faster than the headlines. The ceasefire that was supposed to stabilize everything has effectively collapsed, not in a dramatic announcement, not in one clear headline, but in what followed: failed negotiations, rising oil prices, and a sudden shift in global expectations. And right now, silver is reacting. Not gradually, not quietly, violently. As markets opened, silver dropped sharply, falling towards $74 per ounce, even touching lower intraday levels near $72 before stabilizing. And this didn't happen in isolation. It happened within hours of something much bigger. Because over the weekend, negotiations between the United States and Iran failed to reach an agreement. At the same time, oil surged above $100 per barrel, driven by fears around supply disruptions in the Strait of Hormuz, one of the most critical energy routes in the world. And when oil moves like that, everything changes. This is not just about silver. This is about inflation, liquidity, and the direction of the global economy. Even the International Monetary Fund has already acknowledged that the economic shock from the conflict is now baked into the system, with energy disruptions affecting supply chains, pricing, and global stability, which means what we're seeing right now may not be temporary. It may be structural. If you're finding this useful so far, take a second to subscribe to the channel, because we break down what's really happening behind these market moves, not just the headlines. And yet, here's the contradiction. When the world becomes unstable, precious metals are supposed to rise. Historically, they do. But this time, they didn't. Silver fell. Gold weakened. Even as tensions increased, that's not normal behavior. And when markets stop behaving normally, it usually means something deeper is happening underneath. Pause for a moment, because this is where most people get it wrong. They look at the price and assume the story. But in reality, price is often reacting to something invisible, something like monetary policy. Because right now, central banks, including the U.S. Federal Reserve, are facing a difficult decision. Inflation is rising again, partly driven by energy prices. At the same time, economic growth remains uncertain. And when inflation rises, central banks typically delay rate cuts, or even consider tightening further. That matters. Because silver, unlike bonds or savings instruments, does not generate yield. So when interest rates remain high, or expectations shift in that direction, non-yielding assets like silver can come under pressure. That's not speculation. That's how monetary systems work. And this weekend, that expectation changed. Markets are now pricing in fewer rate cuts than before. Some estimates suggest expectations for rate reductions have dropped significantly compared to earlier this month, which means liquidity may stay tight for longer. And liquidity is everything. Because in modern markets, prices are not just driven by supply and demand. They are driven by flows, capital flows, institutional positioning, algorithmic trading. And when liquidity tightens, those flows reverse. That's when volatility increases. That's when sharp moves happen. That's when assets get sold, not because they are weak, but because capital is being reallocated. And that's exactly what silver may be experiencing right now. But here's the part that makes this situation even more complex. The fundamentals haven't actually changed. Global demand for silver, especially from industrial sectors like solar energy, electronics, and electrification, remains structurally strong. At the same time, supply constraints continue. This creates a paradox. On one side, you have long-term demand. On the other, you have short-term financial pressure. And right now, the financial side is winning. But only for now. because markets don't move in straight lines, they move in cycles. And what we may be witnessing is not just a drop, it may be a transition. And if you want to stay ahead of moves like this before they happen, make sure you're subscribed, because timing matters in markets like these. A shift from one phase of the market to another. The question is, what comes next? Because what happens over the next few days, especially before Monday's full global participation, could determine whether this move stabilizes or accelerates. And if it accelerates, the impact may not be limited to silver. It could spread to commodities, to currencies, to global risk assets. And that's why this moment matters. Not because of what has already happened, but because of what it may be signaling. Because when geopolitics, inflation, and monetary policy all start aligning, markets don't stay quiet for long. They move fast. And sometimes, by the time most people realize what's happening, the move is already over. So the real question is not, why is silver falling? The real question is, what is this move preparing for? Now here's where things start to shift quietly, because what you're seeing right now in silver may not actually be about silver at all. It may be about money itself, because when energy prices rise this quickly, inflation doesn't stay contained. It spreads into transportation, into manufacturing, into food, into everyday life. And institutions like the International Monetary Fund have already warned that this shock is no longer temporary. They've described the economic impact of the conflict as something that is already baked into the system, which means markets are no longer reacting to a possibility, they are reacting to a reality, and that reality creates pressure on central banks, because central banks, especially the Federal Reserve, operate within a very specific framework. When inflation rises, they cannot easily lower interest rates. Sometimes they have to do the opposite. Now think about that. Just days ago, markets were expecting rate cuts. Liquidity was expected to improve. Money was expected to become cheaper. But after this weekend, that expectation changed. The probability of rate cuts has already dropped significantly as inflation risks returned and the dollar strengthened. And when expectations change like that, capital moves. Not slowly, not carefully, quickly. Because institutions don't wait for confirmation. They reposition ahead of it. This is what drives volatility. And volatility is exactly what we're seeing. Silver dropped towards $74, even touching near $72 intraday, before attempting to stabilize. That kind of movement in a short window is not random. It's repositioning. Funds reducing exposure, algorithms reacting to momentum, liquidity shifting towards safer or yielding assets. Because in a high-rate environment, yield matters, and silver doesn't provide it. That's the key. Silver is not being rejected. It is being repriced. There's a difference. Historically, during periods of tightening financial conditions, non-yielding assets tend to underperform, not because they lack value, but because capital is being redirected. This has happened before. During past tightening cycles, during periods of rising real yields, during moments when the cost of money increased. And right now, we may be entering a similar phase. But here's where things get more complicated. European indices weakened, energy prices surged, and volatility increased across multiple asset classes. This is what systemic shifts look like. They don't happen in one place, they happen everywhere. Currencies move, bonds reprice, commodities react. And right now, all of those pieces are moving at the same time, which suggests something deeper, not just a reaction, but a transition from one macro environment to another. And during transitions, markets often behave irrationally, or at least they appear that way, because what looks like a contradiction is often just a shift in priority. Right now, priority is shifting toward stability, yield, liquidity preservation, and away from speculation, long-duration assets, non-yielding exposure. That's why silver is under pressure. not because it lost its role, but because its role is being temporarily deprioritized. And that's where most people get confused. They see price falling and assume weakness. But sometimes price falling is just a reflection of capital moving elsewhere, not permanently, just temporarily. Because cycles don't end, they rotate. And the biggest moves usually happen when the rotation is almost complete. So now the question becomes, is this the rotation phase or something more aggressive? Because if this is just repositioning, then stabilization may follow. But if this is a deeper liquidity event, then this move may not be finished yet. And that's what makes this moment critical. Because what happens next depends on what the system does next. Will inflation continue rising? Will central banks stay restrictive? Will oil remain elevated? Or will something break first? Because historically, when multiple pressures build at the same time, something eventually gives. The only question is, what? And when that happens, the reaction is rarely small. It's usually fast, and it usually surprises most people. So don't just watch the price, watch the system. Because right now, the system is what's moving the market. Now this is where things start to feel wrong. Because if you look at history, real history, not headlines, silver should not be falling right now. Geopolitical tension rises. War risk increases. Energy supply gets disrupted. Historically, precious metals tend to rise. But today, they didn't. On April 13th, silver dropped toward $74, even slipping below $73 at points, reacting immediately after ceasefire talks failed. Gold also weakened, at the exact same time that oil surged above $100 per barrel again. That combination is not typical, because normally, when oil rises and inflation risk increases, investors move into hard assets. But this time, they didn't. And that's the paradox. Pause here. Because this is the moment where most people misunderstand the market. They assume more chaos equals higher metals. But markets don't always work that way. Sometimes they react to something deeper, something like real interest rates. Because here's what changed quietly, almost invisibly. Inflation expectations surged again, driven by energy. At the same time, central banks are now expected to stay restrictive. The U.S. Federal Reserve is now facing a higher for longer scenario, where interest rates may remain elevated due to persistent inflation pressures. And when that happens, real yields rise. And when real yields rise, precious metals often struggle, not always, but historically, often, because metals don't generate income. So when investors can earn higher returns in bonds or cash, capital starts shifting, not because metals are bad, but because opportunity cost increases. This is basic monetary theory, but it doesn't feel basic when it's happening live. If this kind of analysis helps you see what others miss, hit subscribe and stay with the channel, because the next few days could be critical. Because at the same time, the world looks unstable. The International Monetary Fund has already warned that the current conflict is creating a simultaneous shock to growth and inflation, something that complicates global monetary policy, which means we're entering a rare environment where inflation is rising, growth is slowing, rates may stay high. That combination has a name, stagflation. And historically, stagflation creates confusion in markets because assets stop behaving predictably. Gold may hesitate, silver may drop, stocks may weaken, currencies may swing, because everything is being repriced at once. And that's exactly what this looks like. Now add one more layer, the dollar. As rate expectations shifted, the US dollar strengthened again. And that matters because silver is priced globally in dollars. So when the dollar rises, silver becomes more expensive for international buyers. Demand softens, even if underlying fundamentals stay strong. That's why analysts often say dollar strength is pressure on metals. And right now, that pressure is building, So what you're seeing is not just one force, it's multiple forces colliding at the same time. Geopolitics, inflation, monetary policy, currency strength, all moving at once. And when that happens, markets don't move cleanly. They become volatile, which is exactly what we're seeing. Silver dropping 2 to 3% in a single move, while oil jumps, while equities weaken. That's not a single story, that's a system reaction. Now here's where it gets even more interesting. Because despite all of this, the underlying fundamentals for silver have not collapsed. Industrial demand is still there. Electrification demand is still there. Energy transition demand is still there. And most importantly, the market is still in a supply deficit, which creates a contradiction. Price is falling, but structure is tight. That doesn't happen often. And when it does, it usually signals something temporary, not permanent. But temporary doesn't mean safe, because temporary phases are where the biggest volatility happens. And volatility is where most investors lose control. They panic, they react, they exit too early, or enter too late, because the move doesn't make sense. And when something doesn't make sense, people stop trusting their own judgment. That's when markets move the fastest, because confusion creates opportunity, but only for those who understand what's happening underneath. Now think about this. If silver is falling, not because demand disappeared, but because financial conditions tightened, then what happens when those conditions change again? That's the question nobody is asking yet. Because right now, everyone is focused on the drop, but very few are looking at what caused it, and even fewer are asking what happens next. Because markets don't just react, they anticipate, and sometimes they overshoot. So this drop could be pricing in something real, or it could be overshooting fear. And the difference between those two is everything, because one leads to continuation, the other leads to reversal. And right now, we don't fully know which one this is. But we are starting to see clues. Clues in oil, clues in rates, clues in central bank language. And those clues are pointing to something bigger than just a weekend reaction. They are pointing to a shift, a macro shift. And when macro shifts happen, they don't just affect one asset, they reshape entire markets. So the real question is not, why is silver falling today? The real question is this the beginning of a larger repricing or the final phase before something turns? Because what happens next may not be slow, it may be sudden, and it may happen before most people are ready. Now this is where everything starts to come together, and also where things start to feel even more uncomfortable. Because what you're seeing right now in silver may not reflect reality at all. Let's go deeper. As of April 13th, 2026, silver dropped towards $73 to $74 per ounce, falling over 2 to 3% in a single session after ceasefire talks failed. Volatility increased immediately. Markets reacted instantly. But at the same time, the underlying structure of the silver market hasn't collapsed. In fact, most industry reports still point to a persistent supply deficit, driven by strong industrial demand and limited new supply. This creates a contradiction, because in a normal market, a deficit means higher prices, not lower. So why is price falling? This is where you have to understand how modern markets actually work, because price is not determined only by physical supply and demand. It's influenced heavily by futures markets, institutional positioning, ETF, flows, central bank policy expectations. And right now, those forces are dominating. Let's break that down. Most silver trading does not happen through physical exchange. It happens through derivatives, contracts, positions, leverage. And those positions can be unwound very quickly, especially when volatility rises. Now add one more layer, the US dollar. As expectations for Federal Reserve rate cuts declined, the dollar strengthened. And when the dollar rises, it puts pressure on commodities priced in dollars, silver included. This relationship has been observed repeatedly across multiple market cycles. So what you're seeing now is not a simple sell-off. It's a combination of stronger dollar, higher bond yields, reduced rate cut expectations, rising volatility, all hitting at once. And when multiple macro forces align like this, price movements can become disconnected from fundamentals. Temporarily, that's the key word, temporarily, because fundamentals don't disappear, they just get overshadowed. And right now, they're being overshadowed by monetary forces. Now let's talk about something even more important, central banks. Because while retail investors focus on price, central banks focus on stability. The Federal Reserves, the European Central Bank, and others are all watching the same thing right now, inflation. And inflation is rising again, driven largely by energy. Recent data showed U.S. inflation accelerating again, with CPI rising 0.9% month over month, reinforcing the idea that price pressures are not fully under control. That matters, because central banks cannot ignore inflation, even in times of geopolitical tension. The only question is when. Now here's something that very few people are paying attention to. Despite this sell-off, industrial demand for silver is still supported by sectors like solar energy, electronics, EV infrastructure. These sectors are not slowing down overnight. They are part of long-term global transitions, which means demand may remain structurally strong. At the same time, supply growth is limited. Mining expansion takes time. New projects take years. So even if prices fall short-term, the underlying supply-demand imbalance may still exist. And that creates tension, because markets can ignore fundamentals, but not forever. Eventually, something has to adjust. Either demand weakens significantly, or price adjusts back upward. Historically, markets tend to rebalance, but the timing is never obvious. And that's what makes this moment difficult, because right now, we're in the middle of that disconnect, where price is reacting to financial conditions, not physical reality. And those phases can be volatile, very volatile, because they are driven by expectations, positioning sentiment. Not just data, and sentiment can change quickly. Now think about this. If institutions are currently reducing exposure due to liquidity concerns, what happens when those concerns ease? What happens when rate expectations stabilize? What happens when the dollar weakens again? Because those cycles do not stay one-sided forever. And when they reverse, they can reverse quickly, sometimes faster than the drop itself. That's what history shows. But again, nothing is guaranteed. Markets can remain disconnected longer than expected. That's why timing matters. And that's why this moment matters. Because what we're seeing right now may not be the final move. It may be part of a larger process, a process of repricing, rebalancing, and repositioning. And that process is still ongoing, which means the story is not finished yet, not even close. Because the real move often happens after the confusion, after the volatility, after the majority has already reacted. So now the question becomes, are we still in the reaction phase or approaching the turning point? Because the answer to that will define what happens next. Now, step back for a second, because what you've just seen is not just a silver move, it's a signal. April 13th, 2026, silver drops sharply towards $73 to $74 per ounce, reacting within hours of ceasefire talks collapsing. Oil jumps back above $100 per barrel. Inflation fears rise again, and expectations for interest rate cuts fall sharply. At the same time, institutions like the International Monetary Fund are warning that the economic impact of this conflict is already spreading through the global system, affecting growth, supply chains, and financial stability. So this is not isolated. This is connected. And when multiple systems start reacting together, that's when markets enter a transition phase, not a trend. A transition, Because right now, three major forces are colliding: geopolitics, ceasefire collapse, oil disruption, uncertainty monetary policy, central banks staying restrictive due to inflation, liquidity conditions, tighter capital, higher yields, repositioning. And when these forces align, markets don't behave normally. They reprice, sometimes aggressively, sometimes irrationally, but always with consequences. Now here's where things become important, because despite everything you've seen, one fact has not changed. The global silver market is still in a structural deficit, expected to remain short for the sixth consecutive year, with around 67 million ounces missing from supply. That means something very simple. The physical market is still tight. Demand hasn't disappeared. Supply hasn't suddenly increased. So the drop you're seeing is not driven by fundamentals alone. It's being driven by financial conditions, liquidity, positioning, expectations. And historically, those conditions can change, not slowly, suddenly. Because once inflation stabilizes, or rate expectations shift again, or the dollar weakens, capital flows reverse. And when they reverse, they don't ask for permission. They move fast. Now here's the uncomfortable part. Nobody knows exactly when that shift happens. Not retail investors, not analysts, not even central banks with full certainty. Because the system itself is adapting. Even the IMF has suggested that global growth is being reshaped by this conflict, with long-term economic effects already forming beneath the surface, which means we're not just reacting to news anymore. We are moving through a macro shift. And macro shifts don't resolve in a single day. They unfold with volatility, with confusion, with sudden moves that don't make sense in the moment, just like this one. So now the real question is not, why did silver fall? The real question is, what is this fall preparing for? Because there are only two possibilities. Either this is the beginning of a deeper repricing, where liquidity continues to tighten and assets remain under pressure. Or this is a temporary dislocation, where financial conditions pushed prices down faster than fundamentals justify. And if it's the second scenario, then what you're seeing right now may not be the end. It may be the setup. But here's the truth. Markets don't send clear signals. They send mixed ones. They create doubt. They create hesitation. Because that's how positioning resets. That's how weak hands exit. And that's how larger moves build. So right now, as you're watching this, the system is still adjusting. Oil is still volatile. Inflation is still uncertain. Central banks are still cautious. And silver is still caught in the middle of it all, between long-term demand, short-term financial pressure. And that tension has not resolved yet. Which means this story is not over, not this week, not before Monday, because what happens next depends on what shifts next. And those shifts can happen quickly. If this kind of analysis helps you see what others miss, hit subscribe and stay with the channel, because the next few days could be critical, sometimes overnight. So watch carefully, not just the price, watch the signals, watch inflation, watch the dollar, watch central bank language, because those are the forces that are really moving this market. And right now, they are still in motion, unstable, unresolved, and possibly just getting started. Because if this is not the crash, then it could be the beginning of something much bigger, something most people don't see yet, something still building underneath the surface. And by the time it becomes obvious, it may already be too late.